Well, 50 basis points means you got to first look at the dot plot. Google it if you don't know. But the dot plot's telling us that, number one, going over the next year and year and a half and even into 2026, that it looks like the Fed is going to be cutting more. How much more? Well, how about this? So we're sitting here looking at about 5 right now. We're looking at 4.4 by the end of the year. We're looking at 3.4 by the end of 2025 and even down to 2.9. What does that mean to your mortgage rates? Well, guess what? Your rates are probably already reflecting the 50 basis points. They've already been anticipating this drop. But, add a point and a half or 150 basis points to 200 basis points to the end of it, and that's what it could mean. So you're looking at sub 5 potentially in 2026. That would be awesome. Well, as far as refinances go, you certainly have to look at a couple of things. Number one is approximately 39% of homes in America today are paid for, meaning they have no mortgage on them. Of that, though, of those that have mortgages, 87% of them have rates of 6 or below. So what I just said, 5% target rate, you're looking at today at 6.25, give or take. We're still not below, that threshold. So refis, while we're going in the right direction and we're going to see volume, obviously better than what we just had, but it's going to take a little bit. You got to get below 6 before you really start to penetrate into those. As far as existing homes, I think that's important. Again, not only do you have a refi effect that could happen, but as far as existing homes, that is one of the biggest problems we've had in supply. Generally, existing homes dominate sales. Well, as I just said, 87% of those homes that are have a mortgage are 6% or lower. Well, if rates are obviously higher than 6%, you have the lock-in effect. And of course, the average is 6. So that means a lot of people are sub 5, and some of you are even sub 3. Why would you ever sell your house at sub 3? Life happens, we understand. But so we'd love to see the existing homes unlock. That would be helpful. So obviously, as I said previously, getting rates into the 5s, that is starting to unlock some of that existing inventory, and that will be where we really start to see some help. And also, price appreciation's been so much pressure these days because of the fact that there's so few existing homes. Getting supply into the market will help the inflation number as well. Got to look at the dot plot, and it looks good. As I said, to lead off, you could see a Fed funds target of 2.9 into 2026. So bottom line is the next 2 years, we should start to, one, unlock some of that existing home inventory that we need. 2, builders continue to try and keep up. You got to look back to 2012 as an area where we just underbuilt for the next 12 years. So going into the 2008 crash, obviously we had supply. Remember, our dogs had houses. And so now, you come into the last 12 years and we didn't build a lot. Builders were conservative and we're really trying to make sure that they were addressing the needs that were out there. Millennials, the big story was they weren't buying houses. Well, guess what? They're buying houses. So that's good. But as we all know, there's also the economic pressure of the buy side, which we all know the low side and supply side, and God help us in COVID. So let's see.